For decades, the entire grand obsession of finance was finding the needle.
The needle, right. That one single perfect winning stock.
The one that would not just participate in the market, but fundamentally beat it. Today, though, the advice you hear is, well, it's shockingly simple.
Forget the needle. Just buy the entire haystack.
Exactly. And that simple idea, that metaphor, really sums up the biggest financial shift of the last, 50 years?
Absolutely. It's a move away from those active management strategies that just dominated the 20th century.
And toward these passive indexing strategies that now manage, trillions of dollars globally.
Trillions.
And that's what we're diving into. Our mission today is to explore this whole radical shift, how the index fund went from this sort of fringe academic concept to just dominating the world.
And we're going to look at the hard numbers. We've got 120 years of global portfolio data.
But the real challenge here, the thing we have to tackle, is this central paradox. Index funds have been amazing for the individual investor.
Yeah.
But is that success now creating, these massive systemic risks?
That's the question. We're working with market analysis reports, economic theory, deep historical performance studies. We need to understand not just that passive one, but why it won.
And what happens when the winner gets too big?
Precisely.
Okay, let's unpack this. We have to set the scene. What's the core philosophical difference between these two giants?
Well, active management is driven by a very aggressive goal. You have to outperform the market.
Beat the average.
Get the average. And the technique is stock picking, tactical trading. It all rests on the belief that markets are fundamentally inefficient.
Because people are irrational.
Because investors are emotional, irrational, and that creates opportunities you can exploit.
And passive management or indexing is the total opposite. It almost minimalist.
It is. The objective is so much more modest. You're just trying to track a specific index, like the S&P 500.
And the technique is just replication. You buy what's in the index in the same proportions.
And this whole idea is built on the efficient market hypothesis, the EMH.
Which Eugene Fama developed back in the 60s.
Right. And the EMH is really the cornerstone. It suggests that all known information, public, private, everything, is already reflected in the price of a stock, like instantly.
So you can't get an edge.
You can't. Trying to outperform the market using that information is basically a game of chance because you've already missed the boat. The news is already priced in.
But the theory that makes it all mathematically just brutal is William Sharpe's zero-sum game.
That's where the physics of finance really kick in. It's so elegant.
It is.
Sharpe showed that before you account for any costs, the aggregate market return is just the average return of all investors combined. It's a closed system.
So for every single winner, every position that outperforms that average,
there has to be a loser. A position that underperforms by the exact same amount.
Which means the total excess return, the amount by which everyone beat the market, all added up,
is zero. A perfect zero.
So for the entire active management industry to collectively beat the market, they'd have to win that zero-sum game and overcome all their fees and trading costs.
It's a massive, massive headwind.
And active management really took off after the first mutual fund in the U.S., right? Back in the 1920s.
1924, the Massachusetts Investors Trust. But it took almost 50 years for the intellectual counterpunch to really land.
John Bogle writes his thesis in 1951, kind of hinting at the idea.
And then Fama's EMH research in the 60s gives it this academic backbone. And finally, in 1971, the idea takes physical form.
With the first institutional index funds.
Exactly. Wells Fargo and American National Bank. But they were tracking the S&P 500, but for huge pension plans.
Right, like Wells Fargo's first fund was for the Samsonite Corporation pension, only $6 million.
And it still took another 5 years for Bogle to bring the idea to people like you and me.
1976, he launches the Vanguard First Index Investment Trust, and the anecdote is just fantastic.
Oh, Bogle's folly.
Bogle's folly. It raised a tiny, paltry $11.3 million.
A rounding error today.
It's nothing. And that same fund today is worth over $250 billion. The scale of that shift is just, it's hard to comprehend.
And it happened because the data eventually became just undeniable. If we connect this history to the big picture, the long-term numbers just overwhelmingly support taking the market return, especially with compounding.
So we're pulling data that covers 120 years.
1901 all the way through 2020.
Which lets us see how this all holds up through wars, depressions, multiple crazy market cycles.
So to make this really stick, imagine you started with 100 euros back in 1901, and these are net returns, so we're not even factoring in fees or taxes yet.
Okay, let's start with the most conservative option. 100% bonds, maximum security, low volatility.
Right. That initial €100 grows to 11,079 euros by 2020, an average annual return of 4.0%.
Which is respectable. I mean, over 120 years, not bad.
Not bad at all. But now, let's say you get a little more aggressive. A balanced portfolio, 40% equities, 60% bonds.
So you accept a little more risk.
A little more, yeah. Your final value jumps to 67,108 euros. The average annual return climbs to 5.6%.
Whoa, hang on. Just by moving 40% of the portfolio into stocks, just accepting the average return on those stocks, your final pot of money is 6 times bigger.
6 times bigger. That's the power of equities starting to work.
That's already a huge difference.
It is, but here's the indexer's ultimate victory. The 100% equities portfolio.
This is the person who just says, I'll buy the whole haystack and I'll hold it for a century.
And they just wait. That portfolio was worth 437,413 euros by 2020.
Wow.
That's an average annual return of 7.3%.
So you end up with a portfolio nearly 40 times larger than the bond-only portfolio. That difference between 4% and 7.3% a year, that's the true cost of avoiding market risk over the long term.
It's the tyranny of lost compounding. But we have to be honest about the volatility.
Of course, that's the price of admission.
It is. That all-equity portfolio had a worst year of negative 41%, a huge drop. The bond portfolio's worst year was only a drop of about 22%.
But over 120 years, the compounding just overwhelms those drawdowns.
Wait.
So here's where it gets really interesting for me. If the power of just holding the market is that massive, why do active managers still claim they can consistently beat it?
Because they believe they have the skill, but they're fighting that tyranny of costs we talked about.
Right. Sharp's zero-sum game again.
It's zero before costs. Once you add in management fees, trading commissions, market impact, that whole distribution shifts deeply into negative territory for the average manager.
And the evidence on this is just brutal. Study after study finds that the expense ratio is the single most reliable predictor of a fund's future performance.
It's all about cost. High costs almost guarantee underperformance over time.
And look at the failure rate. In any given year, something like 64% of active large-cap managers failed to beat the S&P 500.
And that's just 1 year. It gets so much worse over time.
I was going to say the really devastating number is the long-term one. Over 10 years or more, it's something like 90% of active managers who fail to beat a simple index fund.
90%. And that's only counting the funds that survive.
The survivorship bias.
Exactly. The funds that do really poorly just get merged or liquidated, so they disappear from the data, which artificially cleans up the record for the active industry. The real failure rate is even higher.
Over 15 years, it's what, only 3% of global large-cap funds that actually beat their passive equivalent?
3%. It's a stunningly small number.
And what's wild is the complete lack of persistence. A manager who's in the top 20% for one 5-year period.
Almost never stays there for the next 5 years. There's just no evidence of repeatable, sustained skill. It looks more like luck.
So part of this has to be the closet indexer phenomenon, right? Funds that charge high active fees but basically just hug the index anyway.
Oh, for sure. They're doomed to fail from the start because of their fee structure. They're just passive funds in an expensive suit.
Which brings us to the main defense from the active world, the high active share argument.
Right. The idea that if you strip out all those closet indexers, the true stock pickers, the ones who are genuinely different from the index,
They can still win.
They can. And some studies support this. One found that these high active share funds between 1998 and 2014 actually did outperform. About 61% of them beat their benchmarks.
And they also argue for better downside capture. So they lose less when the market goes down.
They can be more tactical, yes. And there's an argument that as interest rates go up, the difference between the best and worst stocks, the dispersion gets wider.
Which creates more opportunity for a skillful manager to shine.
That's the theory. So that debate is always going to be there. But now we have to shift from the individual investor's choice to the huge systemic impact of passive winning this war.
Because it really has won. At the end of 2023, passive assets officially overtook active assets for the first time ever.
The flow of money is staggering. In the 5 years up to March 2024, investors pulled $1.4 trillion from active funds.
Yeah, and poured $3 trillion into index funds.
And that shift has created this unprecedented concentration of power.
We're talking about the big three.
The big three: BlackRock, Vanguard, and State Street. Together, they manage over $23 trillion in assets.
And most of that, about 75%, is in index funds.
Which means they now control over 20% of the votes in the S&P 500.
This is what John Bogle himself was worried about back in 2018.
He was. He warned that if index funds cross the 50% market share line, the big three could own 30% of the entire U.S. stock market. He called it effective control.
And he said that did not serve the national interest. But wait, write that down. Why does owning the votes matter so much if they're just passively tracking an index? They're not supposed to be intervening.
That's the entire problem. It's called common ownership theory.
Okay.
Since an index fund owns all the major competitors in a sector, think Coke and Pepsi or Ford and GM, they benefit from the success of the whole sector, not one company.
So if they own a huge chunk of both Coke and Pepsi, they don't want Coke to launch some brutal price war that crushes Pepsi's profit.
Exactly. A price war might be great for Coke's market share and great for consumers, but it would hurt the index fund's holdings in Pepsi.
So their incentive is to maximize the return of the total portfolio.
Which, the theory suggests, leads to less aggressive competition. Companies know their major shareholders want stability across the whole sector, not a bloodbath. It can lead to what's called tacit collusion.
And this isn't just a theory anymore. There's data suggesting this has real-world consequences for you, the consumer.
It does. There are studies linking this concentrated ownership to lower wages and employment and to higher prices.
The famous one is the airline industry study.
Right. Researchers found that airline prices were 3% to 7% higher because these big common owners held stakes in all the competing airlines. It just disincentivized price wars.
So beyond competition, you've got risks to market efficiency and governance.
Yeah. Index funds are the ultimate free riders. They benefit from all the price discovery work that active managers do, the billions spent on research to figure out what a company is truly worth.
But as passive gets bigger and bigger, there are fewer active managers doing that work.
And with fewer people doing fundamental research and aggressive trading, you could argue that prices become less accurate, less efficient. The market could get more volatile.
And then there's the governance problem. An active manager has a huge incentive to keep a company's management in check. Their fee depends on it.
But if you're an index fund manager at, say, BlackRock, you hold hundreds, maybe thousands of companies.
Are you really going to dedicate the resources to properly supervise every single one of them, especially when your fee is microscopic?
The incentive just isn't there in the same way, and that could lead to weaker checks on corporate management, on things like executive pay or climate strategy.
So we come full circle back to the paradox. Index funds have been this incredible social good. They democratized investing, giving millions of people low-cost access to market returns.
A huge, tangible benefit.
But their very success, their sheer size, has created this incredible concentration of ownership that now poses real systemic risks to how our markets and corporations are supposed to work.
And policymakers are now trying to figure out how to balance that. How do you keep the benefits of low-cost indexing without paying the price of distorted markets?
A lot of the solutions being talked about revolve around transparency.
Right. Bogle argued for just that. We need more disclosure about how the big three are using their votes. If they have effective control, we need to know what they're doing with it.
And then you have arguments from people like Professor Anat Admati, who says fund advisors should be required to use that leverage to ensure companies are managed in the true long-term interest of their clients, the actual investors.
Not just for short-term corporate stability.
But in the end, for you, the individual investor, the whole conversation really comes down to one thing, doesn't it? Discipline.
It all comes back to discipline.
It's not about finding the best stock picker. It's about minimizing what you pay to play the game and then just staying in the game for decades.
That's the lesson Bogle immortalized. Forget all the systemic complexity for a moment. His central point is still true for the individual. The miracle of compounding returns is overwhelmed by the tyranny of compounding costs.
Pay less, buy the haystack, and let time do all the heavy lifting for you. And that is the undeniable power of passive investing.
But the big question we're left with is, who exactly is minding the haystack?
Something for all of us to think about as this all continues to evolve.